This week on Wealth Track, financial thought leader Tom Gallagher guides us through the global policy and political minefields rocking markets. In a rare television interview, Wall Street's longtime top Washington analyst tells us which policies matter to investors and which don't. Next on Consuelo Mack, Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. If we have learned anything in this post-financial crisis period, it is that policy seems to matter more than ever. In our memory, at least, the role of government in the markets and the entire financial system has never been larger, and the impact that global policy decisions have on stocks and bond prices has never been greater. Suddenly, events in seemingly faraway places like Iceland, Slovakia, and Beijing, as well as Washington, are moving markets on a daily basis. One look at the chart of the S&P 500's gyration since July tells the story. In many cases, the so-called risk-on, risk-off trade, where the market swings from one extreme to another on a daily basis, has been generated by pronouncements and even rumors out of Europe and Washington, which is one reason we called upon this week's Wealth Track guest. Tom Gallagher was voted the #1 Washington analyst by institutional investors from 2001 to 2010 when he hung his hat at independent research firm ISI Group. Last year, Tom activated his long-planned retirement from ISI to give himself time to travel, teach, speak, and consult. He now hangs his hat at the Scowcroft Group, issuing his analysis when needed. Well, the need has never been greater. Even before the financial system imploded in 2008, Tom had been predicting we were entering an era of big government. How right he was. But interestingly, he now believes that monetary policy is less effective than it has been in the past, and that fiscal policy has more influence, for better or for worse. As Tom wrote in a recent presentation, in the U.S., the more effective policymakers, the Fed, are in charge of the less effective policy, while the less effective policymakers, Congress, the President, are in charge of the more effective policy, fiscal policy. Well, why isn't Fed policy having its usual effect? And why does Gallagher believe that fiscal policy is potentially more potent? He says understanding today's world is all about understanding deleveraging.
Well, I think a few months ago it wasn't clear how important deleveraging was to the economic outlook, but the weak performance of the economy and the financial markets has really kind of driven home the point that, that the economy following a financial crisis is different than in a normal business cycle. The economy's weaker, there's a different role for policy to play, there's a different way that investors should approach their investment decisions. Politics is even affected by it.
So, but it's this particular kind of a crisis. It's not, I mean, there are lots of different sorts of crises, but this was a credit crisis, right? And so is that kind of the main difference?
Yeah, I wouldn't want to get overly complicated about it. It was a boom-bust cycle in credit.
Right.
Especially housing credit, but it was a boom-bust cycle in credit. And so the bust side of that just takes longer to work out. If you think about the last decade, we ended up with too many construction workers, too many mortgage lenders, people had too much of their net worth in housing. And you don't just reverse that, in a short amount of time. That much misallocation of resources. It takes a long time to work that through the economy. And that's why this is a different kind of business cycle than a normal business cycle. In a normal business cycle, you have a severe recession, you get a big bounce back. and then you really just need one round of stimulus, and you're back off on an expansion. And in a post-crisis cycle, it just takes longer to recover. You don't get one round of stimulus, you get multiple rounds of stimulus. And it's frankly harder to generate, you really don't get into a bull market, so it's harder to make your investment returns and in capital gains. So it changes a lot in the way you look at things.
So when people talk about a new normal, when they're talking about, a lower economic growth and they're talking about, lower investment returns, that's, you think, no matter what happens out of Washington, that's kind of baked in the cake for a number of years?
Yes. I wouldn't say no matter what happens
in
Washington, because Washington could screw it up and not deliver the kind of stimulus that would keep the economy even performing on a subpar basis.
All right, so let's talk about what Washington's done so far. And I think that, kind of one of the hallmark comments that you made and predictions that you made several years ago on WealthTrack was that we are entering an era of big activist government, and that was kind of the framework through which that you were going to make, just decide what was going to happen in the market and the economy. So we are in big activist government in spades. Yeah. So how's it doing so far? What has the impact been so far? Because a lot of people are saying, it really hasn't worked that well.
Well, I think first thing you measure is the depth of the decline. The research on financial crises show that kind of in an average case, real GDP declines by 10%. In the Depression, it was close to 30%. We had a GDP decline of 5%. So I think policy did a great job of putting a floor under the economy.
And you think it would have been a lot worse had not the Fed and the government stepped up with the TARP, that this kind of stimulus and the bailouts, as they call them, was essential?
Yes.
Okay.
Yes. Barry Eichengreen is an economist, economic historian at Berkeley, and he did an interesting comparison of 1929 and 2008, overlapping industrial production, world trade, global stock markets. And 2009 was as bad or worse than 1929 until you got to roughly the second quarter of 2009. And what happened? Well, you'd passed the TARP and you'd implemented it. You had QE1. You had the stimulus plan. So the policy response, I think, put a floor under what could have been a much more severe decline in output. And I think the critical thing was to save the financial system, which is basically the TARP. That's why the U.S. now and Japan in the 90s are both different from the Depression. From 1930 to 1933, 20% of the banks in the U.S. failed. I mean, imagine what that does. That's what converted the severe recession into the Depression. So I think that's what policy did well. It hasn't restored a good rate of growth. It hasn't brought the unemployment rate down in a material way. I think deleveraging is the kind of headwind that's very hard, that makes it very hard to do that quickly, and I think history has shown that. But that's where policy has fallen short, and that's why voters are upset.
So let's talk about the policy, what's going to happen from here on out.
I think the Fed is signaling that it's not done. But in a deleveraging environment, monetary policy is less effective. So I think you've got this situation where the more effective policymakers are in charge of the less effective policy.
Which is the Fed.
The Fed meets every 6 weeks. They can turn. They're very active.
And they can act.
Signal that they are acting. It's just that their policy is less effective. Some people say it's ineffective or that monetary policy is impotent. I think that's too extreme. But it is less effective. What the Fed can mainly do is drive down interest rates. And high interest rates are not what's plaguing the economy right now. So they're limited in what they could do, but they're doing it and they're very active about it. And so that's why I think it's interesting to look at how stocks responded to the first two rounds of easing by the Fed versus now. The stocks responded very decisively to the March 2009 Fed meeting where they launched QE1 or completed the process for QE1. Responded very decisively when Bernanke signaled QE2 at his Jackson Hole speech in 2010. And now it's been more erratic since the Fed started its third round of easing at the August Fed meeting. And I think that's for two reasons. One is Europe is a bigger drag on markets now than it was the first two rounds. But the other is that I think the markets are now kind of embracing a lot of the implications of deleveraging, that monetary policy is less effective. So to some extent, I think stocks are pricing in the risk of a recession, namely lower earnings. But I think they're also pricing in a lower multiple, that a lower price to earnings ratio. That's because in a deleveraging environment, the economy is weaker. It doesn't grow as strongly as it does in a normal business cycle. So it makes sense that the multiple is going to be weaker as well. So that's why I think stocks haven't responded as decisively to this round of easing compared to the first two.
So, Tom, pretend you're an economist. Do you think that we are in a recession?
We're not in a recession now. We could be, but I think there are elements of the third quarter GDP report that make you worried about how sustainable that 2.5% growth rate is. That consumption was strong, but it was at a time when income was actually declining. Consumption was able to go up because people were saving less, and that's not a sustainable source of economic growth. Capital spending was strong, but maybe that's because you've got the expiration of the investment incentive at the end of this year. That could be a reason that's doing well now. So I'm not sure how sustainable the growth rate is. I think, though, that maybe my biggest question about the economy next year is what happens on fiscal policy. Fiscal policy probably works better in a deleveraging environment than in a normal business cycle.
And why do you say that, Tom?
It's because you have more households who are constrained, cash constrained, so that you provide them some extra income, they're more likely to spend it. Next year, fiscal policy is actually set to become a pretty material headwind to the economy. That's because of the expiration of some provisions scheduled to expire at the end of this year. You've got some of the spending cuts that have been already approved for next year. The stimulus bill from 2009 is winding down. We'll have about $100 billion less stimulus in 2012 than in 2011. Then you've got what's going on at the state and local level. So you have all these things combining to make fiscal policy a headwind next year. And so I think that, to me, that's the important thing on what Congress does on fiscal policy this year. It's nice if they make progress on long-term deficit reduction. In fact, it's important that they make progress, but they don't have to solve that problem. But at the same time, they've got to make sure that fiscal policy doesn't become too much of a headwind for the economy next year. Under calculations by the International Monetary Fund, we look at fiscal policy being a drag of as much as 2% of GDP next year if they don't extend these provisions. And I think that's probably too much for the economy to bear. So I would probably expect a recession if Congress doesn't at least extend these expiring provisions this year.
So what about the super committee? What kind of an impact could the super committee have on as far as a headwind to the economic growth?
I think of the super committee as having really three effects overall on the economy and on the markets. There's what they do on their mission, which is to reduce longer term deficits. And frankly, markets haven't cared about that. You know, that they didn't reward the UK when the UK embarked on serious, significant deficit reduction. They're cutting their deficit by 1.5% of GDP each year for 4 years. They haven't gotten materially lower interest rates relative to the rest of the world. But I think that they need to do that just to guard against. It's kind of an insurance policy to make sure that markets don't start to doubt U.S. Treasuries. But I wouldn't expect. I think the most important thing there is they do enough deficit reduction to prevent a downgrade by the other rating agencies, by Moody's and Fitch.
So that would be enough. I mean, that would be an accomplishment.
I think so. Who knows?
Right.
But I think that would be enough because markets aren't that worried about longer-term deficits in the U.S. So if you make progress on that, I think that's useful. The second thing, and I think the more important thing, is what happens to the economy near term. You know, the markets are very sensitive to near-term growth prospects. The U.S. is bumping along, and if fiscal policy becomes a headwind next year, I think markets get more nervous about that. So what the Congress does this year about the expiring payroll tax cut and extended unemployment benefits, I think is a very important factor for markets. But then the third is, I think the super committee just has to avoid another demonstration of political dysfunction in the U.S. Markets reacted negatively to that in the debt ceiling fight. To be clear, the same stakes are not present now that were in the debt ceiling. You know, if they didn't raise the debt ceiling, then the Treasury faced a cash crisis that could quickly turn into a macroeconomic crisis. That's not going to happen now. But you know, there is some research that suggests that business and consumer confidence can be affected by gridlock over fiscal issues. So, and downgrades, I think, contribute to that too. So if they act in a way that produces a downgrade, if the Congress acts in a way that produces a downgrade, then I think that's a negative too. So you've got these various ways the super committee and the whole fiscal policy process will affect the markets this year. Frankly, as I look at it all, I think it's a little less important, maybe a lot less important than what's going on in Europe now. But there's still important things that markets will be looking at this month.
So let's talk about Europe and what your concerns are there as a policy wonk.
They're multiple. For example, In the U.S., when we did the TARP, Paulson wanted his big bazooka, get a number bigger than the size of the problem. Same thing happened during the Asia crisis or during the Mexican crisis. You look back, several years. The idea was to overwhelm the problem. The more resources you threw at it, the less likely you were to have to devote those resources to the problem. And in Europe, they keep trying to calibrate it. They don't want to increase the size of their European fund to rescue these countries or to buy their debt. And I think that's what's going to keep it very hard for policymakers to get ahead of the problem in Europe.
So it's death by 1,000 cuts.
I'm not saying it's death, but it keeps for a very weak environment. And I think, as a lot of people are pointing out now, it's even if they could get past this debt problem, and I say that as a big if, but just to get past that, then you're looking at economic conditions that are very weak. We're probably going to have a recession in Europe because they got tight money. The ECB recently eased, but they still have tight money, tighter monetary policy than most other developed countries. And they've got tight fiscal policy, and now their banks are going to be raising capital that makes them less willing to lend. So you have a lot of reasons why they've got a lot of headwinds to growth in Europe.
Isn't that a big headwind for us as well?
It's a headwind. Net exports aren't the driver for the U.S. economy the way it is for a lot of smaller countries, but it's definitely a weight on U.S. growth prospects.
It's so interesting in having this conversation, it is that how important the macro picture and policy decisions are on a daily, almost hourly basis in the markets. So, you have this risk-on, risk-off trade that seems to, again, happen on a daily basis. So why is it now that policy seems to have such a huge impact on our confidence and investor confidence in the market, or have we been through periods like this before?
Well, we have, but that's been a long time. I do think, to go back to the whole deleveraging framework, that it's a policy-driven outlook. That when you go through these waves of stimulus, when the economy performs weaker than expected, it has to perform weak enough to generate a policy response. And so getting the timing of that right is very important to guess when the markets will then start to rally based on that. And if they rally enough, then you get a little sense of complacency. But then when the economy disappoints again, then it's time for policymakers to step in. So the role of policy, I think, is to kind of trigger these rallies and sell-offs that you see in the financial market. So I just think in a deleveraging environment, you've got a bigger role for policy. It's very different from, say, the late 90s, where investors just wanted to know the next tech stock they should buy. That was a bottom-up kind of market, but I think in a post-crisis economy, it's very much a top-down kind of market.
So it's a perfect place to be as a Washington analyst, Tom
Not
Gallagher,
bad.
no question about it.
I've got no complaints.
So let's talk about 2012. We've got a big election coming up here. We've got an election coming up in France, but let's talk about 2012 in the U.S. And so what do you think? What are the prospects for a re-election or for an upset?
Well, I think the economy drives most of election outcomes. They don't determine it, but it largely determines how competitive the election is going to be. And the one variable, if you had to pick one, a lot of people like to use the unemployment rate, but I think that studies have shown that a better measure is real disposable personal income, because that captures both the inflation side and it captures what's going on in wages. It's a good measure of how people feel. It's what their take-home pay is. And I'd say that has to improve by at least a percentage point for Obama to feel good about re-election prospects.
And how doable is a percentage point? How big
it's been going in the other direction.
Is that?
It's been going in the other direction.
It's been declining.
So, exactly. So, for example, the last read we had, that number actually went negative. So even though spending went up, personal income was actually declining, again, because households reduced their saving rate. So that's, even though the GDP number looked good for Obama, you look at the underlying trend as dictated by real disposable personal income, and it wasn't positive. So I think that Obama could still get reelected. Most everything has to go right, and things rarely go right. Everything rarely goes right. So I'd say the odds are against him, but I'd say maybe 40% probability.
Another thing, as a longtime Washington analyst, that you've said, it's who is in the White House is not a reason to be in and out of stocks. It's a reason to be in certain kinds of stocks or out of certain kinds of stocks. So President Obama is in the White House now, so where should we be now? What kinds of stocks should we be in based on who is in the White House?
Yeah, I have said that. I've said that throughout my career. I'm not sure it'll apply after the next election, depending on how the economy looks in the policy response, because I think 2012 really is going to come down to activism versus austerity. And that's that Obama has been a very activist president. Republicans are advocating austerity. Everyone has said they'd replace Bernanke as chairman of the Fed. They all want to cut the deficit more aggressively. And so it's too soon to tell, because we need to know what the economy is going to be looking like in 2013. But it's just too soon to start talking about the investment implications of the election. I think there are things you can say about the kind of investment choices you want to make in a deleveraging environment.
Right.
But that's kind
now,
of independent.
So kind of investments that work in a deleveraging environment now.
Yeah, I think most of us got used to, over the bull market, of equating our investment returns with our capital gains. How much is a stock going to go up in price? And we neglected the other part of the return equation, which is income. Mm-hmm. And I think if you look at other countries that have been through deleveraging situations, they don't have bull markets in stocks. So they do tend to trade in a wide range. Stocks do. So if you're really good, you can try to time it, buying the lows, selling the highs, and try to do that. I'm not good enough to do that. So I think instead you look at income. And you try to, and this is, a lot of people have explored this theme, it's nothing new, but I think there's still opportunities to do that, is to look at the kind of securities that generate a decent income for the risk that you're willing to take.
And so the income is where you think, in a deleveraging environment, that's where we're going to get a return from.
Right. I mean, there are various categories that are kind of obvious: master limited partnerships, real estate investment trusts, tax-exempt bonds. And you have to, adjust for your own risk profile, because some of these are too risky that I wouldn't go into. But I do feel like the policy response in the U.S. removed the big downside risk. Like I said, we limited the drop in GDP. We didn't have a depression, and so you can take some risk in your portfolio, but you don't want to take too much risk. And so I think all these categories offer opportunities.
So, and just a couple more questions about policy. And I guess, is there a policy outcome that you are concerned about, that you feel that actually could push the U.S. into a recession? You talked about fiscal headwinds.
Right. I think in a deleveraging environment, voters see high deficits and they see a weak economy, and they assume that the deficits cause the weak economy. It's really the other way around. The weak economy is causing the high deficits. But that historically has led governments in deleveraging cycles to withdraw fiscal stimulus too soon. And I think that we're at risk in repeating that mistake in this post-crisis cycle.
One investment for a long-term diversified portfolio is?
Consistent with the idea of looking for income. I think there are a lot of opportunities, for finding income. The one I've picked for this is the Starwood, STWD, which generates a high payout. But also, it's kind of a deleveraging play. It's a firm that is going to address the refinancing problem that a lot of commercial real estate firms are going to face. They've got bank loans that are going to come due in the next couple of years. Those banks don't want to renew those loans. So if you have a good management in charge, they will extend the loans to the good risks. And so it's a kind of it combines a deleveraging play, if you will, with the income theme.
Starwood.
Yes.
Tom Gallagher, thank you so much for joining us on Wealth Track. It's always a treat to have you here.
Thanks for having me. I enjoyed it.
Speaking of important policy issues, this week I had dinner with former Wyoming Republican Senator Alan Simpson, who is on the warpath about reducing our huge federal debt and putting our government back on a sound and sustainable financial footing. His partner in this fiscal reform campaign is a Democrat, Erskine Bowles, president of the University of North Carolina and former White House chief of staff under President Clinton. Now, you might remember that last year they co-chaired the president's bipartisan National Commission on Fiscal Responsibility and Reform and issued a sweeping long-term deficit reduction plan titled The Moment of Truth. Now, officially, it went nowhere. It didn't get the support of enough panel members to forward the proposal to Congress for a vote. But 11 of the 18 panel members did vote for it, 5 Republicans and 6 Democrats together. So this week's action point is read the moment of truth. It's only 66 pages. It is a blueprint for how bipartisan politics can work effectively. There are no sacred cows. Everything is on the table. It makes everyone a little angry. But if enough of us get angry, maybe we can get some action. We will have a link to it on our website. I hope you can join us next week. We have a WealthTrack exclusive. Do you remember Sir John Templeton? Well, we're going to sit down with hedge fund manager Mark Holowesko, the man Sir John picked to run the Templeton funds back in 1987. Mark is now a great investor in his own right, and he's going to share what he learned from Sir John and where he is finding value right now. I can't wait for you to see him. Now, some of you won't have to wait until next weekend. If you want to see Mark Holowesko or other WealthTrack guests ahead of the crowd, subscribers can now see our program 48 hours in advance, along with timely interviews exclusive to WealthTrack web subscribers. To sign up, go to our website, wealthtrack.com. And that concludes this edition of WealthTrack. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally, and Wintergreen, your home for global value.